Welcome to This Explainer. Today, we're diving into the notoriously messy digital plumbing of international money movement. If you've ever tried to wire money overseas, or maybe you run a business dealing with international suppliers, you already know the global financial system can feel like an absolute maze. Well, we're going to break down exactly how this system works, where the roadblocks are, and how some incredible new technologies are literally tearing those roadblocks down.
Okay, think about this massive figure, $31.6 trillion. That's trillion with a T. That represents the staggering size of the B2B cross-border payments market last year alone. In a global economy that literally never sleeps, cross-border payments are the fuel keeping the engine running. And you know, this demand is only exploding. Driven by e-commerce, remote global workforces, and hyper-interconnected supply chains, this number is projected to hit a whopping $50 trillion by 2032.
But here's the glaring contradiction. If there's so much money moving globally, and it's so vital to the world economy, why is the actual experience still so painfully slow? Seriously, we can beam a high-definition video across the globe in half a second, but moving a digital dollar? That can still take almost a week.
To untangle this, our agenda covers 5 parts. 1. The global money engine. 2. The legacy banking friction. 3. Regional payment innovations. 4. Upgrading the global rails. And 5. The blockchain settlement revolution.
Number 1. The global money engine, powering international trade and remittances. Let's start by looking at what makes up this massive ecosystem. These transactions covered the whole spectrum, from massive business-to-business supply chain operations, like an Indian exporter selling to global clients, all the way down to a migrant worker sending personal remittances back home to their family.
The money flows heavily through specific remittance corridors. Take high-volume routes like the US to Mexico, which is heavily driven by family remittances, or the UAE to India, driven by expat labor. These routes are absolutely crucial. They form the vital financial backbone of the global economy, providing capital flows that often completely eclipse foreign direct investment in developing nations.
Number 2. The legacy banking friction, the hidden costs of correspondent banking. So to understand where we're going, we really have to look at the severe friction dragging down the old system. When you hit send on an international wire, the currency isn't being physically loaded onto an airplane. In fact, it doesn't really move at all in the way you'd think.
A traditional payment doesn't just flow smoothly, it awkwardly jumps through 4 distinct multi-party hurdles. First, initiation, where you instruct your bank. Second, compliance, passing through complex anti-money laundering and KYC screenings. Third is routing, where the message literally bounces between multiple intermediary or correspondent banks. And finally, settlement, where the destination account is actually credited. It's so incredibly vulnerable to delays at every single step.
And because of all those intermediaries taking a cut and checking boxes, businesses and consumers really suffer. If you're a small business operating on super thin margins, giving up 3 to 7% to fees and waiting up to 5 days for your own money, that is absolutely devastating. It chokes cash flow, creates hidden foreign exchange markups, and traps commerce within arbitrary banking hours. The legacy system is basically holding international trade back.
Number 3. Regional payment innovations, building localized bridges. Now, instead of sitting around waiting for a global fix, specific regions around the world are fighting back. They're linking their domestic instant payment systems directly to their neighbors. India is an absolute pioneer here. They've aggressively expanded their Unified Payments Interface, UPI, on a global scale. By linking UPI directly with systems in places like Nepal, Singapore, and the UAE, they're turning multi-day remittances into instant, seamless mobile transfers. And under the Reserve Bank of India's new PACB framework, non-bank platforms are strictly regulated, capping these cross-border imports and exports at 25 lakh rupees per transaction. So it's fast and it's highly secure.
Meanwhile, over in the Middle East, the Gulf Cooperation Council built a unified system called AFOC. Recognizing the massive volume of regional trade they handle, they decided to build a core payments infrastructure to bypass those slow, expensive correspondent banks entirely for transfers within the Gulf.
Think about the pathway here. AFOC connects the domestic real-time gross settlement systems directly across the GCC. So, picture a worker in Bahrain sending Bahraini dinars. Their family in Oman instantly receives Omani rial. It happens in real time, in central bank money, at fixed daily exchange rates. No hidden FX markups, no crazy multi-day waits, just an instant transfer.
Over in Europe, the approach is driven heavily by regulation. Mandates like the Instant Payments Regulation for SEPA are basically forcing the issue by law. Cross-border payments within this area must now be processed instantly, making transfers as fast as domestic ones. This kind of clarity means lower costs and predictable real-time settlement for European businesses.
Number 4. Upgrading the global rails, modernizing traditional infrastructure. Now, regional systems are fantastic, but what about global transfers that span across continents? Well, the massive global players are scrambling to upgrade their legacy rails to keep up with this modern demand for speed.
Global service providers are definitely leading this charge. Giants like Visa Direct are expanding their push to card networks for immediate cross-border reach. At the same time, SWIFT, the messaging network connecting over 11,000 institutions globally, is aggressively modernizing. Since a whopping 80% of cross-border transaction time is lost in last-mile regulatory checks, the industry is adopting the global ISO 2022 standard. This richer payment data drastically cuts down on those manual reviews and annoying delays. At the infrastructure level, we're seeing some truly incredible innovations. Take MasterCard Move, for example. They successfully piloted a cross-currency setup using the TIPS platform, achieving atomic settlement between euros and Danish kroner. What that means is both currency legs were completed simultaneously. It totally proves that regulated, real-time cross-currency payments can settle in central bank money without the usual liquidity risks and funding friction.
Number 5. The blockchain settlement revolution, bypassing legacy rails entirely. Because, sure, upgrading the old system is great, but blockchain technology isn't just an upgrade. It's actively replacing the legacy rails by allowing direct, peer-to-peer value transfers between institutions.
The contrast here is just absolutely stark. With legacy rails, you have multi-day waits, expensive fees, and you're completely constrained by time zones and a web of intermediaries. But with blockchain rails, you get instant settlement, costing fractions of a cent, available 24 hours a day, 365 days a year. It's literally the difference between mailing a physical check and sending an email.
But businesses can't really have their payments fluctuating wildly in value while in transit. To understand how this works without the crazy volatility of traditional crypto, you've got to understand stablecoins. These are digital tokens pegged to the value of fiat currencies, like the massively popular USDC pegged to the US dollar. They give businesses the exact price certainty of traditional dollars, but with the lightning speed and transparency of a blockchain.
We're seeing this revolution in action right now with solutions like Ripple payments. By leveraging both their native digital asset, XRP, and their newly introduced stablecoin, Ripple USD or RLUSD, they give fintechs a vastly superior way to move money. Transactions settle in near real time. You get total visibility into fees, and their network now confidently covers over 90% of the world's foreign exchange market.
Behind the scenes, making all of this safe and compliant, are infrastructure giants like Fireblocks. They provide the enterprise-grade custody and compliance tools that banks actually need to use this tech. Get this, Fireblocks is already processing 10 to 15% of global stablecoin volume. That is over 35 million transactions a month. They're the secure foundation allowing hundreds of banks to operate entirely outside of legacy banking hours.
And it's not just private tech companies getting in on this. The public sector is fully on board too. Central banks around the world are actively exploring their own central bank digital currencies, or CBDCs. Projects like mBridge, which is a groundbreaking collaboration between multiple global central banks, are successfully piloting official digital corridors that completely bypass traditional correspondent networks for instant wholesale settlement.
So let's look at how this all builds together into a cohesive ecosystem. You've got all these different blockchains, CBDCs, and legacy systems. Networks like Chainlink act as the essential translation layer. Through their cross-chain interoperability protocol, they securely move digital assets between different blockchains and even connect these modern digital networks back to the traditional SWIFT messaging standards that banks still use today.
Which leaves us with this final, massive question to think about. This transition is happening right now, shifting from slow, opaque, multi-day batch processing to continuous, instant, peer-to-peer settlement. If your business can settle a cross-border payment instantly on a Sunday night for fractions of a cent, how much longer can the old correspondent banking system truly survive? Thanks for joining me for this explainer. I hope it helped untangle the incredible future of global money.